This is part 2, a continuation of the previous video about the behavior of big players. Now we come to the most important part, and is the most difficult part for the big players, which is cooperation between themselves. They have to cooperate, otherwise they will undermine each other and nobody will win. Why they have to respect and treat each other as equals? Because each big player possesses the lethal weapons. What are the lethal weapons again? The lethal weapons are insider information, lots of cash, and lots of shareholdings. Since the big players are not that many, they know each other, and they try to avoid undermining each other's schemes. One situation is that when one big player wants to push up a stock, the other big players will hold or buy in unison. Because if the other big player sells, then the price don't move, because it negates what the other big player wants to do. So for them, this is very important to coordinate, to give the appearance of a competitive market. There are bound to be times when there are opinion clashes between the big guys, because one may think one way and the other may think the other way. In that case, they will come to negotiate for an orderly transfer of their stocks. One big guy may transfer his stock to another one, but it's usually done in the off-hours trading or some other manners, so that everything will move smoothly and orderly. To avoid conflicts, the big guys usually divide their territories, just like the mafia. A couple of big guys control a few stocks, and another small group of big guys control another group of stocks. In this way, they don't step on each other's toes. And when they want to merge territories, they will do it by negotiation and arrange an orderly merging of the territories. Or they may like to transfer the territories. In that case, they will do it too by negotiation and coordination. And sometimes they also do orderly stock swaps. I've got some stocks, I want to exchange them with yours. In that case, it's also done by negotiation and coordination. As time goes by, the outstanding shares of a public company will increase due to growth. And there may be some other changes, like some big players may drop out and some new ones will come in. In any case, the number of big players are small, so they make an effort to get to know each other. There may also be a situation where there are new big players coming in. Those are what we call guerrilla biggies. They are newcomers with lots of cash, but since they are new, they have no respect for the established rules of communication and coordination among the big players. The old boys of the exclusive club do not like these guerrilla biggies because they don't respect the rules. And sometimes it may happen that the old boys gang up and try to teach the new guys a lesson. As time goes by, the new guys will learn the rules and to behave accordingly. And all of them understand that the big guys have to profit together, because if they undermine each other, they cannot profit at the expense of the small guys. Finally, let me show you an example of how much a big guy can control a public company. Let's look at some public companies now. General Electric, GE, is a symbol. Outstanding shares, very big, 10.5 billion shares out there in the market. Average daily turnover, 150 million shares. And institutional investors, that means the percentage of the total number of stocks owned by the big guys, 56%. You look at another company, Goodyear Tire and Rubber. GT is a symbol. Outstanding shares, 0.24 billion, a very small one compared with GE. Daily average turnover, very small, 5 million shares. Because the number of shares are small and the turnover are small, you find that the percentage of institutional holdings is quite high, 81%, as compared with 56% for GE. Now we look at another one, Applied Materials. Outstanding shares, 1.3 billion. Average daily turnover, 22 million shares. And because of a relatively smaller number, the institutional investor percentage is also high, 78%. Based on the above information, we can draw the following conclusions. It is easier for the big guys to move Goodyear than General Electric. Why? Because of the outstanding shares and also because of the low average daily turnover. Also, it is relatively easier to move the stock of Applied Materials than GE because of the lower average daily turnover. Even so, it does not mean that the big guys don't have the upper hand against the small guys. Why? Because the big guys are few and they are well coordinated. So if the big guys want to move GE, they can do that easily. All they need is to come together and coordinate their actions in the marketplace.